What's up everyone, it's Karthik with MoneyVest. So in this video, we are going to be talking about should you buy this dip or should you buy this correction in the NASDAQ or the S&P 500? And is this trend reversal for real in the market? So as always, I like to work with a lot of data and a lot of spreadsheets. So what I've done here is that I've essentially gone back to over 200 years worth of data. And again, I repeat, 200 years worth of data here for S&P 500. And I've essentially gone back to 1800s to really account for the total return on the S&P 500 to better understand where we are. So as of 2024, as you can see that we are at an 8.6% return so far year to date. This is after the pullback that we have witnessed in the S&P 500. And I'm going to show you a very, very important bell curve, which is going to be over here, as well as a very, very interesting analysis, data-driven analysis based on statistics and a lot of really important stuff. All I'm asking in return is that you enjoy this video and find it helpful and share it with a friend or family member or another trader or investor, because I think this is going to be very, very useful information. You're probably not going to find this type of information anywhere on YouTube. I can pretty much assure you, because when I was doing some research on this, not a single video was going over things that I'm going to go over in this video, and the way I'm basically breaking the data down. So all I'm asking in return is that you drop a like and share this with a friend, family member, investor, trader. I would really appreciate that. It's word of mouth and recommendations and referrals like this that help us grow our channel. So like I said, what I've done here is I've essentially taken into account all the returns for the market going back as far as 1825. To put things in perspective, had you invested, let's say, $1 back in 1825, instead of not being born, you would have been up to over $5.4 million had you not invested any money, ever. Had you just taken the courage to invest $1 in 1825, you would have had over $5.4 million. So you really were FOMOing before even you bought. So you were missing out on opportunity, man. Come on. So that's the overall return for the S&P 500. So what I have here that I essentially wanted to take into account and take a look at how well the market has done over the last 200 plus years. And this is the overall pyramid of returns, or the bell curve, if you want to call it. So one of the things that you'll notice with this type of chart is that it is indeed like a bell curve. So if I bring it up in this sense, you'll notice that it actually has a very simple pattern of working in this sort of fashion, right? So it is a bell curve. So if you've studied statistics in your classes, you'll notice that majority of the events happen, or the commonality of these events are happening over here. And then if you take a look at the tail events, which are the rare occurrences in the markets, they're happening over here on the tails of this entire sort of bell curve, right? So you'll notice that these are the extreme down years and these are the extreme up years for S&P 500. So if you really break this data down and we come down closer, you'll notice that there's only been 1 year in the entire history of the S&P 500 over the last 200 plus years where the S&P 500 was down over 40% in the entire year. And we're not talking here from all-time highs to the trough, because we've done a separate analysis on that. We're talking for the entire year, the returns for the entire year for the S&P 500. There's only been one instance in 1931 during times of Great Depression is when we have experienced the S&P 500 closed down over 40% from its all-time highs. 1937 was another year, down over 35%. 2008 was another year, down over 37%. So this is not accounting for, like I said, the peak to trough moment in the S&P when it was down over 50%. Again, we've done a separate analysis on that already, but this is accounting for the entire year and how we closed for the entire year. We closed down 37% in 2008. So you'll notice that, of course, as the thresholds increase, so 20 to 30%, we have experienced more 20% down years than 30% or 40% for obvious reasons, because the market's going down to those levels of being down over 30 to 40% is more rare than the market's going down 20% or more. 10 to 20%, as you can see, is significantly more now. So if you come over this is going to be a lot more than 20 to 30 or 30 to 40 or 40% or more. And then 0 to 10%, it's even more common for us to see a bit of a pullback in the S&P 500, and that has also happened quite a few times, mostly in the 1800s, as you can see, and then also in the 1900s. Very few times we've seen the markets down over 0 to 10% in 2000s. We have experienced bigger sell-offs in 2000s here, and I'll go over that in just a minute as well. Now, when it comes to the greenery, you'll notice that this is obviously there's going to be more green years than there are red years, because overall the markets have pushed higher. They've hit new all-time highs time and time again, and this right here is the overall distribution of the green years that we witnessed between 0 and 10%, 10 and 20%, 20 and 30%, 30 and 40%, 40 and 50%, and 50% or more. And the interesting thing is that there are five instances each for when we have seen returns from the S&P 500 between 40 and 50% and 50% or more. And the cool thing is that we have not yet seen a 40% more year for the S&P 500 in 2000s. So ever since the turn of the century of 2000s, the S&P 500 is yet to record a year where it actually goes up 40% in a year. So that's also what we will break down in our statistics table here. But this right here are the 10 times the S&P 500 is up over 40 to as much as over 50% in a given year. And if you scroll back again, you'll notice that majority of the times the markets are green. So there are more green sells and more green sort of instances and years in the market than there are red. So that in itself should tell you the markets in general tend to perform really well and pushes higher. So this is the statistics over here. The total observations we have are 200. So those were 200 observations right there that I just showed you, of which positive years were 143 and negative years were 57. So that is a win percentage of 72% for the S&P 500. 72% of the times the markets have ripped higher on a given year, with a max gain of 57% happening in 1879. So that's the maximum gain that we've ever experienced for the market in a given year in 1879. And the max drawdown, the most drawdown we've ever experienced, as I showed you, was during the 1931 Great Depression sell-off, and that was over 43%. Total return at over 81 million%. This is including for dividends. This is including for dividends as well. So that's over a 81 million%. I believe if you exclude for dividends, I think the returns just come up to over 5 million%, which you can see that significant difference, right? Dividends are very, very underrated and underappreciated, I feel, because dividends also do account for majority of the return for the S&P 500, and those are just ways of companies to give back to the shareholders, and accounting for that, the return is just astronomical at over 81 million%, and the compounded annual growth rate over the last 200 years at over 9.28% for the S&P 500. Now, coming over to some different centuries, so 1800s, 1900s, and 2000s, and this is exactly why I mentioned that you're not going to find this type of information analysis anywhere on YouTube. I've done the research, I've done a lot of homework on this, spent a lot of hours kind of creating these spreadsheets so you can actually understand statistically how well or how poorly the markets have done. So all I'm asking is, again, drop a like and subscribe to the channel and share this video with a friend or a family or a trader or another investor that you know that can benefit from this type of analysis. So when it comes to 1800s, the average return has been 6.5%. The median return has been just under 6%. So though returns were low, we were also dealing with low levels of volatility. So even though we did experience somewhat lower returns in the 1800s, we only experienced a max drawdown of 21%, meaning that in a given year, we only really witnessed a 21.3% as the max sell-off in a given year in the 1800s, and the maximum gain of 57%. In the 1900s, that number increased to over 12% average return and a median return of just under 12%, with a max gain of almost 54%, so just shy of the 1800s, but it was also coming in at the expense of twice as much volatility, because we did experience a max drawdown of over 43% during the Great Depressions, during the 1930s, and that was a 43.3% sell-off in that year. But also we had higher, almost double the average or the median return on an annual basis in the 1900s. Now comes 2000s. And 2000s, it's only been 24 years, 24. In fact, the 24th year is actually going on right now. So the average return we have seen on an annual basis, 9.5%, a median return of over 13.6%, and a maximum return of 32%. And that, in fact, I think happened, if you come over to this, and let's just, actually, you know what? Let me just go back to this chart. and then I'll show you. So if you go over to 2000s, so 2000s minus 9.1, minus 11.8, minus 22%, 28%, 10.8. So try to look for 26 or 32% was that number. 2013 is when we experienced a 32.39% gain. So that's that number here. That was 2013. So about 11 years ago. So it's kind of crazy to think that despite all the technological advancement and despite all the progress we've seen, the S&P 500 has not yet recorded an increase of over 40% in a given year. And that's probably because market caps have, gotten bigger and bigger. So it takes more money to move the market than it did back in the 1900s and 1800s is my guess. That, back then the markets were of course smaller, companies were smaller. So even a little bit of capital pushed the markets to over 57%, 54% in a given year. But 2000s, we are yet to see a breakout, a record year of over 35%. That's not happened ever in 2000, in the last 24 years. And it's also come at significantly more volatility. So what you'll experience here is that in the 1800s and in the 1900s, the max gain was more than the max drawdown in a given year for S&P 500. But in 2000s, we saw a bit of a flip where the max drawdown was actually more at 37% than the max gain in a particular year. And that 37% sell-off happened in, 2008, of course. So 2008, that was the great financial crisis. And that's when we experienced the markets sell off a little bit over 32%. But the cool thing is that this is another really, really mind-blowing statistics and data here. So what I did was essentially calculate the rolling averages or rolling returns for 5-year, 10-year, 15-year, 20-year, and 30-year periods. So in other words, you pick any 5-year period in the market for the last 200 years. What is the probability that you're going to be positive versus negative? Similarly, you pick any 10-year period, any 15-year period, any 20-year period, and any 30-year period in the last 200 years for the S&P 500. What is the probability that you're going to be profitable? And what is the probability that you're actually going to make money? And the numbers are actually quite mind-blowing because the shorter the time frames, the more volatile the markets are, the more uncertain the returns are. But the longer you go out, the more smooth the returns can be, and the more predictable and the more consistent returns can be. So what you'll notice here is that if you take a look at the 5-year rolling average, right, rolling returns here. So in other words, pick any year in the last 200 years, pick any year, and you invest for 5 years. Okay, so you go back 200 years, you pick any year out of the hat, and you invest for 5 years, the probability of you being profitable 5 years later is over 84%. 84% probability that you actually end up making money, 15.3% probability that you're actually going to lose money. You do the same exercise for 10 years, and now your probability increases to over 96% probability that you're going to be up from your original investment. This is not accounting for you adding more money or your dollar cost averaging. This is simply accounting for the return of the S&P 500 in a given 10-year period. The negative is 3.6%, and again, that is an anomaly. That is a rare occurrence. I mean, we may have experienced that during the Great Depression or during the Great Inflation times when the markets really moved sideways. But given a 10-year period, the probability is extremely high for investors to be up in that particular time period. Now you do that exercise for 15 years and now your odds increased over 98% and only negative 1.6% probability that you're going to be down. And 20 and 30 years is 100%. You pick any 20-year period in the S&P 500, there's 100% probability that you are going to be up in 20 years and in 30 years. So, and again, of course, 40 years, 50 years, the longer you stay invested, the concrete and the more probable it is going to be that you actually make money in the market. So that's why people say that time in the market beats timing the market, because markets tend to be incredibly volatile in shorter terms than they are in longer terms. So coming back to the markets and where we are right now, we're at an extreme fear. We are back down to the CNN index of 19. This is extreme fear in the markets, and the MoneyVest index, as we already discussed, has plummeted down to 3. So you can see that it's trading at 3.04, coming down to very close to that green rectangle, that band where the markets tend to be extremely oversold. Valuations are coming down. We are seeing volatility now at over 31.87. However, it's been selling off, so down over 17% on the day right now as it continues to sell off. And we saw a peak of over 66. So you combine a lot of these, understandings of data and statistics that the volatility at over 66 was the third highest volatility ever recorded in the history of volatility. So if you come back to this chart, as I shared earlier, if you go over to the monthly chart, you'll notice that the VIX over here recorded its highest level, third highest level it's ever been. The history of the volatility here, you'll notice that we have never gotten up to over 65 more than 3 times. The last time we were at those levels was during the pandemic and the crash of 2020. And prior to that, we're going back to the great financial crisis of 07-08. Just think about that for a second. This data goes back over 30 years, and this is the third highest volatility ever. So how rare does that become when it comes to the volatility in the markets in general? Extremely rare. And then you compare that with the bell curve, as I showed you earlier, and the returns of the overall market over 200 years. So it absolutely makes sense why there is opportunity here in the markets as they are selling off, as they are coming down 8%, 10%, 12%, 15% from their all-time highs in a correction or a pullback or even a bear market. There is opportunity to buy and to invest. So that's what I'm doing. I should have actually bought a little bit more and been more aggressive yesterday. But again, could have, should have, would have is the worst thing to do in the markets, and just take it day by day. Look at the risk reward, understand that odds and probability is in your favor if you're looking to invest in the long term, especially 10 years out or more. And then, of course, take advantage of the opportunities when the markets present them to you. So hope you all enjoyed this video. I will be buying a little bit more today. Although the markets are green pre-market, QQQs are up over 93 basis points. SPY is also up a little bit over 70 basis points. So yes, in the short term, there can be some more volatility. Nobody really knows that. Are we done with the sell-off? Or is the bottom in? Is this the beginning of a trend reversal? Can't really say with any confidence at the moment, because a lot of that depends on the short-term volatility. Of course, it depends on the overall situation related to the carry away trade that we talked about in our yesterday's video, as well as the recession fears and short-term weakness in the S&P or in the markets in general. But if you've got a long-term horizon, if you've got high-quality companies on your radar that you've always wanted to accumulate, now is the time to get going and start dollar cost averaging just a little bit, right? So not saying go all in, but just a little bit that you can start buying in. So hope you all enjoyed this video and a complete update on this. Make sure that you drop a like, subscribe to the channel, and also do share this video with another person that is interested in this type of analysis, another trader, investor, friend, or family member. I would love to know that. If you have any questions, let me know in the comment section down below. As always, happy investing. I'll see you all in the next video.